Imagine waking up one morning in 2026 and realizing that everything people believed about the markets was wrong. Imagine the portfolios that looked invincible yesterday now bleeding red. Imagine headlines screaming collapse, fear choking the streets of Wall Street, and billions wiped out in minutes. Now stop for a moment, because while the world is terrified, you are calm. Why? Because you knew this moment was coming. Unlike the millions running for the exit, you're walking into the fire with a plan. The world's markets are soaring, indices climbing like rockets, valuations breaking every rule of logic. Every headline whispering the same hypnotic phrase, "This time is different." You've seen this movie before. .com bubble, housing crisis, COVID crash. Everything always looks invincible right before the fall. Now picture the horizon of 2026. The colors start to shift. The music changes. It's not a collapse, not yet, but a pivot. A sharp correction shaking the fragile bones of a global financial system built on optimism, leverage, and blind belief. Suddenly, fear spreads. Not just any fear, but a tsunami of panic. Markets spiral, liquidity dries up, and the media scrambles to interview analysts who warned about this all along. While all this chaos unfolds, you're already moving, not out of fear, but out of preparation. Here's the secret almost no one truly understands. Every market crash plants the seeds of the greatest fortunes. It sounds counterintuitive. It feels uncomfortable. But history repeats itself in whispers before it screams. In today's video, we're going deep into the mindset, the mechanics, and the step-by-step strategy that could turn a 2026 crash into the single greatest wealth-building opportunity of your lifetime, not through luck, not through prediction, but through preparation. Right now, we're witnessing a market environment that mirrors past bubbles. S&P 500 is at stretched valuations rivaling the dot-com era. AI, electric vehicles, semiconductors, everything is priced as if perfection is guaranteed forever. Corporate and government debt is climbing to historic levels. Central banks are exhausting their easy money tools. Geopolitical tensions are rising. And retail investors are pouring money into ETFs at record highs. To put it simply, the conditions for a major adjustment are not just present, they're brewing. For someone paying attention, this isn't a reason to panic, it's a reason to prepare. During a sharp market drawdown, prices stop making sense, but emotions take control. Fear becomes the dominant currency. People sell not because assets are bad, but because their emotions demand relief. That's when the real opportunities appear. Assets that were overvalued become undervalued. Strong companies get punished with the weak. Prime real estate becomes distressed. Corporate bonds sell for pennies on the dollar. The formula is simple. Cash plus clarity equals opportunity. But most people never have either, because they only react, they don't prepare. Step 1 is identifying the assets most likely to crash hard. Every bubble bursts the same way. The first to fall are over-leveraged companies, hype-driven growth stocks, high-valuation tech, debt-heavy industries, and speculative assets with no earnings. Today, that could include certain AI startups valued on hype, EV companies dependent on cheap credit, tech stocks priced as if growth will never slow, or real estate firms drowning in debt. You don't need to run from the market, just need to know where the cracks will appear first. Step 2 is preparing your liquidity. This is the most emotionally difficult part. Everyone loves to buy when the market is green, but millionaires are made when everything is red. During panic selling, charts look broken, news looks terrifying. Social media turns into an apocalypse feed, and everyone says, wait for it to go lower. That's exactly why you must have dry powder cash ready. Not maybe cash, not I'll sell later, but actual liquidity you can deploy. Cash isn't for safety. Cash is for opportunity. Step 3 is predefining your buy list. You never make shopping decisions during panic. You make them before the storm hits. Write down 3 to 5 companies you believe in long term. The price levels at which they become a bargain, and the percentage drop required for you to buy. Could be 30%, could be 40%, could be more. Decide now. When the crash comes, your emotions will betray you, but your plan won't. Let's walk through a hypothetical scenario. It could start with a disappointing AI earnings season, a credit event from an over-leveraged company, a central bank policy misstep, or a geopolitical shock. Momentum reverses. confidence evaporates. Tech stocks fall 30 to 50%. Debt-heavy companies collapse. Liquidity tightens. The headlines turn brutal. ETFs experience massive outflows. Retail investors run. Institutions hedge aggressively. Bond yields jump. Real estate slows sharply. This is where 90% of investors make the same mistake. They sell because others are selling. If you're prepared, this is your moment. You deploy your cash. You buy strong companies punished unfairly. You pick up discounted bonds. You look at distressed real estate. You stay unemotional. When recovery comes, and it always comes, the strongest assets rebound first and fastest. And you, the prepared investor, are positioned beautifully. It's important to stay grounded. Some companies go bankrupt. Some assets never hit previous highs. Some sectors suffer structural damage. That's why selectivity matters. Be a value investor. Focus on assets that not only survive, but become stronger on the other side. Just like investors who bought banks in 2009, airlines and travel stocks in 2020, or tech giants after the dot-com crash, contrarians become legends. Remember, a market crash doesn't only hit stocks. A 2026 downturn could affect real estate, commodities, corporate debt, emerging markets, private equity, infrastructure, and even safe havens like gold. The Financial Stability Board has already warned that global asset valuations are misaligned and vulnerabilities are elevated. That means opportunities could appear in places most investors never even look. To structure your portfolio for a crash, allocate a portion to defensive assets now, high-quality bonds, cash equivalents, and gold. This reduces psychological pressure during the downturn. Create your buy list with price targets. Reduce exposure to speculative assets, overvalued growth, hype-driven tech, weak balance sheets, cryptos with no utility, and debt-heavy real estate. As the saying goes, when the tide goes out, you see who's been swimming naked. We were talking about this now because the crowd still believes in a one-way ticket to endless growth. Optimism is highest when risk is highest, and that's exactly when the smallest shock can create the biggest collapse. Some analysts predict the S&P 500 could reach 9,000 by 2026, and in the same sentence call the current market a beautiful bubble. This contradiction is the warning sign. The higher the expectations, the harder the fall. You cannot predict the exact day of a crash. Nobody can. But you can prepare. When the crash comes, big or small, only two types of people will exist: victims and beneficiaries. Decide which one you'll be. Write your buy list. Build your liquidity. Prepare your mindset. Stay contrarian. Stay rational. Stay ready. Wealth isn't about avoiding chaos. It's about navigating chaos with clarity. A 2026 crash, if it happens, won't just be a threat. It could be your defining moment. If you found this perspective valuable, don't forget to like this video and subscribe for more deep, insightful financial content. This is Finis Glow, helping you navigate the markets with courage, clarity, and strategy.